Portfolio Builder members, welcome to our Thursday Trade Alert, where we play 40% of our total portfolio in the bond market. We have a great presentation for you, and a little later today, a live income trading webinar. So make sure to check your email for that access link. It starts in about 55 minutes. Daily income trade alerts at noon Eastern. Target return of investment is 1% a month, and we've only had one losing month with a negative 1% return, an average of 1.5%. Here's our current trade allocation recommendation: 48% equities, 40% bonds, 12% gold. Target income of $750 per month per $75,000 invested. Here's the breakdown. We're trading the SPY ETF, which holds 504 top American companies. Monday, Wednesday, Friday, taking advantage of the only ETF with 3 option expirations a week. This makes it an income monster that we love to trade. 200 shares in the emerging markets ETF on Tuesday. 200 shares of the TLT ETF, that's our bond portfolio, on Thursdays, which we'll be covering today. And then a buy and hold 250 share position in GDX. That's the gold miner ETF. Hey Ron, how's it going? Thanks for saying hello in the chat box. And if anyone else is listening, please say hi so we can know you're out there. Our simple 4 ETF portfolio is extremely diversified. Just between the SPY and emerging market ETF, you'll have over 1,500 stocks in your portfolio. And again, our goal is income and safety, not growth or speculation. Simplify your holdings, reduce your risk, get better results with less work, and weatherproof your retirement portfolio. For every $300,000 invested, our goal is to generate a $3,000 per month profit. And if you look in the description box, you can find a 3-year financing plan to gain lifetime access to both our bootcamp and advisory. Here's what you'll get: easy to follow daily income trade alerts Monday through Friday at noon Eastern, followed by this video, which is a 1-hour video teaching you how to place the trade and the thinking behind the trade. You'll also get a spreadsheet just like ours to track your results and tutorials on how to fill it out. And this is also with a weekly webinar. Now, if you do want to participate in our bootcamp, we're not just going to catch the fish and put it on a silver plate for you. We're going to teach you how to do the fishing yourself. And this turns you into an options trading machine that can print safe profits out of the stock and bond market. This is primarily a webinar that goes out every Tuesday live, where we teach you the inside workings of our strategy. So if you're ready to get started, call Dean now at 505-322-7515. And again, if you'd prefer to check out all the information, go to the description box and there's an advisory application. We're going to make sure you have what it takes to succeed with our strategy. Also, if you scroll down in the description box, you can go to our updates tab. That's where every single trade alert has been issued. It's not behind a private wall. It's free to look at. So you can see every trade alert we've done over the last 11 months with every screenshot and every video. Also, if you want to check out our track record, the link's in there as well. So we have nothing to hide, and look forward to you auditing our returns. Let's take a look at today's trade alert. So we got LeBron on the new Chinese $100 bill. That's a joke. So the TLT has been very generous to us this year with the profit in 9 out of the last 11 months. And it's the easy play when there's fear in the market. So we have a lot of things going in our favor for the TLT. And despite the little sell-off over the last 2 weeks in the TLT, we remain long. It's the easiest and safest way to protect our assets as we predict the potential for a major rally in equities over the next 4 weeks. And so we have the central banks lowering interest rates around the world. We have the Fed buying up $100 billion of treasuries per month. So there's very limited downside to the bond portfolio. Until the trade deal is really lock and loaded, and not just phase one, but phase two, I will not want to be on the other side of the TLT. So we'll take a look at this in more detail. Here's a summary of the news that's in your trade alert email. Larry Kudlow, the whole trade team, wants us to believe that phase one deal is highly likely by November 15th, when President Xi and Trump will be meeting in Chile at another unrelated trade meeting. But the Chinese Commerce Ministry is demanding that all tariffs be dropped, not just delaying the December tariffs, as well as blocking a new pro-Hong Kong bill that's being pushed through U.S. legislature as we speak. So once I go to the news feed, we'll talk more about that. The deal is certainly not a sure thing yet, and that's why I want to continue to be long the TLT and gold, with all of the major forces really in our favor. So the big question is, will Trump really tarnish his reputation among China hawks just for some agricultural purchases? I'm not sure if he will. So meanwhile, here's a look at our portfolio returns per strategy and in total, so you can see how we've been performing. Our average return per month is currently at 15.4% if you were to compound the profits. Now in the trade screenshots below, this is assuming you took the profits off the table each month for whatever income needs you had. So that's the little slight difference in how we've calculated our year-to-date return in this screenshot versus just the total return. So it's been a wild start to October. We started off up 1.1% thanks to the TLT rocketing higher on fears from a trade deal breaking down, only to see the TLT crash somewhat, about 2%, with the surprise on Friday where the two parties actually shook hands, did a joint conference after the market closed, and said they were on track for a trade deal. And so you can see our December return, when the last equity sell-off caused a lot of pain in portfolios. We had a 1.2% return. In May, when the S&P 500 was down over 5.5%, we pulled off a 2.2% return. In August, when the trade tariffs did hit the markets, equities sold off, we have a 1.8% return. And so this strategy works extremely well, especially when unfriendly events hit the equities markets. So if you're all in on equities, you might really pay attention to this video because we're not out of the forest yet. Here's a look at our bond portfolio, which we're trading today. Again, it has been very generous to us. We've only lost in 2 of the last 9 months, and I don't think the party is over for the bonds. We may get a little bit of a break for the next month, 2 or 3, as this hope for a phase 1 trade deal comes in. But the phase 2 is pretty much extremely unlikely to occur and will cause more volatility whenever these trade talks break down. So again, we got the Fed purchasing treasuries, clearing the balance sheets off the banks. They're most likely going to pump these equity markets extremely high on this hope of a trade deal. And so there's limited downside risk on the bonds. But at the same time, they act as a great buffer to protect our assets as we go long equities, really for the first time in several months, where we have an overweight position in equities. So here's a look at the SPY. It's had a slow summer and fall. You can see it had a negative return in May, July, and September. But every other month outside of those, it has generated a profit. In October, so far, it's up 0.4%. My prediction is the SPY can trade to the $315 to $330 range with all of the catalysts coming into play. And just to summarize them, number one is the phase 1 trade deal, where I believe the only concessions from the U.S. will be delaying the December 15th tariffs and potentially some easing on Huawei, while the Chinese in return will primarily just buy a lot of agricultural products. I think that's enough. That doesn't make either party look bad and has good reason for both parties to make that deal. That'd be very bullish. But on top of that, we have the Fed bailing out the banks. Usually they do this after a stock market crash, but they're doing it as the S&P 500 is nearing all-time highs. So this is absolutely crazy. They should be keeping the balance sheet tight. They should be raising rates. They should be forcing all the malinvestment out there to go bankrupt, but instead they're supporting it. So we'll take a better look at that in the near future in this document where we look at all the top news. But the bottom line is they're not doing that. They are pumping the system with tons of liquidity, and that's extremely bullish for equities. The only thing that could really stop equities at this point, from my perspective, would be a major, major escalation in the trade war. And to top things off with a little cherry on top for us, we have Brexit potentially coming to a deal. Who thought that would have ever happened? So it's not quite yet in the books, but they are potentially going to vote on it this weekend. Now, I'm not an expert on the Brexit deal, but this is, again, a positive for equities. In the Tuesday play, we only have 10% of our portfolio versus 30% on the SPY, and currently we're holding the emerging market ETF. While I believe the SPY could travel up to the 315 to 330 range, I believe emerging markets could easily go back to its recent high. So that's a 20% return for our Tuesday play and a potential 10% return for our SPY. Now, the way we play this is very conservatively with option callers. So we're not going to capture necessarily 100% of that move. But if the things don't go the right way and markets crash, we have those put options that have paid off so many times in our portfolio. So we'll keep a close eye on that. I expect at least the next 4 weeks to be relatively smooth sailing, again, as long as both parties, U.S. and China, don't get crazy. Also, the portfolio on Tuesday, you can see it, is designed to have greater risk to reward ratios. Lost 4% in December, lost 1.3% in May, lost 1.3% in July, lost 6% in September. Despite all those losses, it's up 18.4% this year and has had some significant moves like January up 7.7%, June 6%, and so far in October up 3.4%, partially from a silver play and partially from emerging markets already going up since we got into that position this week. Precious metals, I do want to point out that we started off with a relatively smaller position size back in December because we had a opposite central bank policy. They were tightening the balance sheet by not reinvesting all the bonds that were coming to their term, and then they were also increasing interest rates. So they completely flip-flopped. And starting in February, started reducing rates in July, September. I'm expecting they will reduce the interest rate by 25 basis points in October and another 25 basis points in December. And don't forget, they're going to announce some huge injection of liquidity into the system to get rid of all this repo madness that continues to hit the... Okay, we got some comments out there. Don't get excited about Brexit. They're at the exact same point May got to, and it got rejected. Yeah, I've had a hard time following it because of all the drama in there. It is funny to look at all the Brits yelling at each other in the parliament, though. So we've been gradually increasing the position size in this portfolio. In December, it was just a simple 2.5% position in Bitcoin when it was at $3,000, as well as Ethereum and a handful of other cryptos. And as we saw the Fed completely reverse course, did the Fed pivot, or the Powell pivot is what they've nicknamed it, and we've gradually increased this portfolio's position size to 10% of our assets. But as we did that, we reduced risk by getting out of super risky assets like Bitcoin, and now we've primarily been holding gold, silver, and a tiny position in the cryptos. So I would suspect that there's very little downside in the precious metals. There's really three magic ingredients to profit from precious metals. Number one is we want central banks in general to be lowering interest rates. Check, we got it. Number two, we want the central banks to be printing money. Well, print, we got it. China just injected several 300 billion yuan, which divide that by 7, that's a considerable amount of cash. The U.S. is dumping $100 billion into the markets per month and suspected to put between $300 to $1 trillion in a one-time shot before the year ends. Plus, we have the ECB talking about a bazooka of stimulus coming. So we got two of the most important ingredients to be long precious metals. The third is fear. So expect these assets to jump up significantly the next time we get some bad news. So again, on the TLT and precious metals, I don't mind a little bit of volatility and drawdown in that portion of our portfolio, as we suspect the equities will deliver the profits. The big thing about our strategy is we know that it's a random walk, that there's events that will occur that we cannot predict that can cause severe losses. So we have to have a balanced portfolio that is weatherproof and can protect us against shocks in the market. So let's take a look at the new trade alert for the TLT ETF, which represents 40% of our total assets. And again, if you are a member, you'll have had this sent to you in a text message, an email, plus you get this video. This is the summary, and it's based on 100 shares. Now, if you didn't take last week's trade, you would skip step 1 and go to step 2. But if you did take last week's trade, buy to close the 146 call for a penny. That's a debit to our account, and then sell to close the October 18th 139 put, and that's a 22-cent credit to our account. To open the new trade, sell to open the 143 call, and then buy to open the 138 put. So we took in a credit of 20 cents, and then we used that to help finance part of our downside protection, which cost 48 cents. So let's look at this risk graph and see how it plays into the total strategy here. We have $2.91 maximum profits because we sold the 143 call and then also gave up 46 cents on the put. So if the TLT flies up higher, most likely it will be because of trade talks breaking down, bad economic data in the state side, or a very dovish Fed saying they're going to drop rates more than the market expects. So if any of that were to happen, you got to remember we have a 2-to-1 ratio of the TLT versus the SPY. So we basically have about $6 of downside protection from the TLT because of that 2-to-1 ratio. So we have to keep that in mind when we design our trades on the SPY ETF and the emerging markets ETF, because this is our biggest position that does provide the downside protection. And so when I choose our put options primarily on the SPY and the emerging markets, I'm keeping in mind that until next Thursday, I only have $6 of absolute protection relative from the bonds to the stocks. Now that does not count the gold position, but this is a far larger asset allocation. So that's really the breakdown and thinking behind this trade. Let's take a look at some of today's content. This just made me laugh really hard. And South Park has another episode out. I don't normally watch South Park, but this season has been really funny and all about exactly this China sellout. Look at the stocks this morning. Everything's up. I like emerging markets better than VGK, which is the European ETF. But there's a lot of hope and optimism that if a Brexit deal were to come through, that VGK could be another good play. Most likely won't be part of our portfolio, as my specialty has been clearly focusing on the relationship between U.S. and China. So I really don't suspect us changing the portfolio at all. The only thing I would say is I would love to jump into silver if and when I see a serious breakdown in the trade talks. And we'll talk about that a little later. Let's look at the SPY ETF. Here it is. It's had a terrible time getting over this 300 level for the last several years. And will this finally be the catalyst to drive it higher? And it's not the trade deal. It's obviously not growth prospects. It's really the quantitative easing is the biggest signal that we know to be long. If the Fed is injecting trillions of dollars into the banks, you better not bet against it. TLT, a little bit of a sell-off. This has been a huge winner all year, and I believe it has another push dramatically higher in the books before the next election. That's November 2020. So we're, again, happy to have a little drawdown in this position, knowing that there's limited downside risk, because the Fed is actively buying the treasuries. They're clearing the banks out of these positions, freeing up their cash, and so the risk to the downside is very limited because of that, but the upside potential is still there. These banks will have 100% cash positions that they can buy either the bonds if things break down or equities. So again, we like this allocation currently. Emerging markets, just to get back to that recent high, is $52. It's currently at $42. That's about a 20% move back to the recent high just in 2017. Now, can it break beyond that with the phase one deal? Potentially, yes. May it get close to that as we get near the deal and have some hints at a deal by November 15th? Maybe. Now, again, we're playing this safe. The flip side of this coin is that China is in a major problem in terms of credit and debt. So if the trade deal were to break down, we would definitely flip the strategy to profit from emerging markets crashing. As you can look at just the last time they had a slowdown in 2015 and 2016, it crashed all the way down to the 28 level. GDX is the best bet for the precious metals right now because the spot gold has already had a strong rally to that 1500 level. So we played GLD, spot gold, all year, had some great profits on it, and now we've been playing GDX, which is the gold miners. Dollar has been softening for the past month, and this makes sense with the Fed lowering interest rates, adding money to the banking balance sheets, but still remains very elevated. There was some sort of fraud that was discovered of a child porn site or something crazy using Bitcoin that may have been potentially suppressing prices. Again, the same formula for crypto as for precious metals in terms of predicting direction, but add in the element of the government seizing money in your country, and you'll really get people fleeing to these assets. So I still like being long Bitcoin with 1% of our total portfolio and 1% in Ethereum. Now, keep in mind, we're taking that 10% position in GDX and removing 2% of that to buy these two assets right now. If you don't like crypto, just stick to gold. It's the same idea. You'll get a very similar return. And again, there's no reason to stress about it if you don't have the crypto. Here's another trade we're looking at doing in our boot camp. This is to short the Chinese currency in the futures market. The idea is you sell the currency at today's price and buy it in the future at a discount. Per futures contract, every 10 cents this moves higher, we can generate a flat $1,000 profit. So one futures contract represents $100,000 of USD against CNH. So this is a trade we would like to put on soon as the trade deal may break down. Now the catch here, and the reason why I was waiting to put this trade on this week, was because part of the phase one trade deal is they may force the Chinese to peg their currency so that if they act inappropriately, mainly stealing technology, subsidizing industries, using any kind of unfair trade practices, if they do that, the U.S. wants to be able to impose tariffs that will actually hurt specific companies as their enforcement mechanism. And if they simply go devalue their currency, that just offsets all of our actions and causes a ripple effect through all of the emerging markets to devalue their currencies to keep the trading exchange rates fair. So the U.S. is trying to get them to stop manipulating the currency and devaluing it. So again, that's one reason we've halted that trade alert and standing by to see what comes of this trade deal. In commodities world, oil's at 60. I like oil between 50 and 70. If it drops below or above, that can cause concerns. If it were to go below, I'd go heavier in our bond portfolio. If it goes higher than 70, then that can spell trouble for both equities and bonds as it creates inflation. Gold remaining very, very strong at that 1496 level. And again, I don't see a lot of downside risks, so we're not hedging that part of our portfolio with puts currently because we have 2 out of 3 of the magic ingredients for precious metals to go long. The silver to gold ratio is at a 24-year extreme. That's why we want to play it on Tuesdays once we think there's some potential fear in the market to drive it higher. And again, we would rotate out of silver spot, which is SLV, into the silver miners, SIL, if we really saw a breakdown in the trade deal and spot silver jump to around $22 to $25, which is the same play we did in gold and the same methodology we're using in cryptocurrencies. So right now we're long Bitcoin and Ethereum, but if I were to see Bitcoin jump up close to that 20K all-time high, I would want to get out of Bitcoin and rotate into some of the smaller cap coins like Ethereum, and we can go down the list. And speaking of confiscation, Monero is up 10%, outperforming all the cryptos today, and that's one of those privacy coins. Okay, so as far as predicting the bond market, I like to look at the German 30-year yield. That's the closest thing that can be a leading indicator for our TLT, and it's also highly dependent on its relationship with China, which I believe will be the next Lehman moment that takes down the world economy. The question is when. Now, if we can really strike a deal with China and open up their markets to pump billions of dollars into it, they can keep this gravy train of debt growth going for a lot longer. But if the trade deal breaks down, I suspect this German 30-year bond will go back to negative territory and start to test just how negative it could potentially go. So we can look at our U.S. yield sitting at 2 and jumping up a little bit this past 2 weeks. And I think that the likelihood of China really giving up all of its competitive advantages in the world will not be done this easily. Think about it. What pain has the U.S. really seen to get what it wants? None. It really hasn't seen anything. There's no inflation. The stock market's at all-time highs. We're getting debt at record low levels. Really, unemployment's at extreme lows, 50-year lows. So I don't think the U.S. has had enough pain for the Chinese to really succumb. Now, may they be interested in buying some agricultural products? Perhaps, because they are having food inflation, and their worst nightmare would be upsetting 1 billion people because they can't feed themselves and they have to pay 70% of all income, which is only $12,000 a year, to taxes. So they get free medical, free housing, but they don't get free food. So, all right, let's take a look at the top news. Fed injects $104 billion via overnight term repos, 1 day after the start of a not QE. Jeffrey Snyder, frequent guest on Macro Voices, a great YouTube channel I like to listen to. It's not clear what exactly he's saying. He's been spouting these messages on Twitter for quite some time. All the while, the Fed keeps you trying to fool you. Yes, fool you with bank reserves. The global problem, dollar shortage, has nothing to do with the level of bank reserves. Nothing. After everything that's supposedly been done since mid-September, we are still asking, where are the dealers? So the big question is, why aren't the banks lending money to other banks overnight? Is all of their capital accounted for? And if so, can they support some sort of market crash? Maybe they can't. McConnell, Washington Democrats have been engaged in a 3-year-long impeachment parade in search of a rationale. Prominent House Democrats were promising impeachment at the very beginning of this presidency. Fairness and due process are not their objectives here. So I'm mainly watching for his tweets to say anything negative about Trump. I know they're not happy about the Middle East, the army pulling out of the Middle East. And so again, if we were to get some sort of impeachment, we'd want to be prepared for that, primarily with our bond portfolio. Speaker Pelosi is still blocking the USMCA, a major trade deal that would create 167,000 jobs. White House advisor Kudlow, forced technology transfer is likely to be a phase 2 issue with China. Reiterates a lot of cooperation over the trade pact. Secretary Mnuchin also said that he was happy with progress thus far. So all of the little sound bites from the U.S. have been very positive, and there's been relatively positive sound bites from China, which is rare. Usually it's our side saying everything's great, and China is saying, I don't know, this is not a fair deal. We're not going to succumb to Trump's demands in an unfair deal. Chinese Commerce Ministry spokesman, our aim is to end the trade war and remove all tariffs. Hope to make progress with the U.S. in removing tariffs. So, from what we heard from Trump, all the past tariffs would remain intact, and we'd just not put on the December tariffs. So if that's the case, I don't think Trump will have a lot of backlash for a phase 1 deal. But if he goes and removes all tariffs just for some agricultural products, that might cause quite an uproar. Meanwhile, the Chinese are not happy about this and have vowed retaliation. They haven't said what they'll do, but last night I voted with the House to pass 3 measures to support the millions of protesters in Hong Kong fighting for basic human rights. This is from Kyle Bass. Reserves are collapsing in Hong Kong. While they appear ample to the untrained eye, the most highly leveraged financial system in the world can't afford to contract its money supply. That's exactly what's happening today. And we're seeing capital flight in both China and Hong Kong at record pace. And this is while China is doing everything they possibly can to try to control capital flight and not allow any money to escape China. But yet they're still finding ways out. Breaking, the Hong Kong Human Rights and Democracy Act has cleared the House of Representatives onto our colleagues in the Senate. Yesterday we had Pelosi wearing a Support Hong Kong t-shirt. This could get ugly quick and potentially halt the trade deal. Hong Kong is critical to China as that's their means of getting outside capital to continue their debt binge and crazy building plans. Meanwhile, Security of Exchange and Department of Justice charged massive ring of Chinese fraudsters with manipulating 3,000 U.S. stocks, altering bank statements, pumping and dumping, lies, theft, and pretty much anything else you can imagine. I took a few screenshots of it. Here's some of the fellows. Some of them live in the U.S., some of them are living in China. They were creating lots of trading accounts, buying and selling the assets very quickly to raise the prices and then dumping it. Made millions of dollars doing this. Jimmy Sham, leader of the Hong Kong Democracy Group, attacked by Xi's thugs with hammers. Sham must have been uneducated. They're making reference to LeBron about Hong Kong matters. Time to put the Magnitsky Act sanctions on Carrie Lam and her cabinet of terror. And that's a wrap for today's Trade Alert, guys. Let's see if we have any questions before we prepare for our live webinar in 20 minutes. All right, guys, really appreciate it. And we'll see you in 20 minutes on our live webinar, which will have the replay going out Saturday. So thanks again. And our SPY ETF will have a nice profit to take off the table tomorrow. So look out for tomorrow's Trade Alert on the SPY at noon Eastern.